I want to first congratulate Tax Analysts on its 50th anniversary. It's not easy for an organization to last 50 years. The average small business survives 8.5 years, and fewer than 1 in 4 last 15 years. To last 50 years, through all the economic ups and downs, through all the changes in the interests of an organization's customers and all the changes in the business environment, is an extraordinary accomplishment. I attribute much of Tax Analysts' longevity to its fervent adherence to its mission of providing a forum for the informed exchange of tax ideas, its constant pursuit of tax transparency, and most importantly, its people. So to Tom Field, Kara Griffith, and all who have contributed to Tax Analysts' success and longevity, congratulations. You've made a real difference. Second, to Larry Gibbs, who will be honored tonight, I also want to say congratulations. Larry is one of those exceptional people who has made a difference not only in tax policy and tax administration, but in the lives of millions of people through his work as IRS Commissioner and as an active member of the tax profession. He is one of the smartest, most collaborative, thoughtful, caring human beings I've ever met. When I became the IRS Acting Commissioner, Larry wrote me a 3-page email filled with great advice. I didn't ask him to do it. He didn't have to do it. He did it because of who he is. I was thankful for the advice and will always be indebted to him. Congratulations, Larry, on an honor well deserved. In my remaining time this evening, I wanted to touch on a few topical tax policy and tax administration matters that I hope will be of interest to you. Let me start with tax policy. Many in the tax profession are rightly feeling overwhelmed by the size and speed of tax policy changes over the past 3 years. Since the Tax Cuts and Jobs Act, the Treasury Department and IRS have issued all the essential guidance necessary to implement its 118 provisions. 537 pieces of guidance have been issued, including 59 final regulations. Some of the regulations were less than 100 pages, and most were several hundred pages. But those 59 regulations and 478 other pieces of guidance constitute a lot of reading and absorbing. In addition, all the forms, instructions, and publications affected by TCJA have been amended. Add to that 3 tax bills in the past 10 months. The Families First Act with 2 novel employee leave credits that are refundable against employment taxes, which is a first. The CARES Act with economic impact payments, the Employee Retention Credit, and a number of other tax provisions, and the Consolidated Appropriation Act of 2021 with more EIPs and more tax provisions. To implement the Families First and CARES Act, IRS and Treasury issued 13 pieces of IRB guidance, 2 sets of proposed regulations, and hundreds of FAQs. With the Consolidated Appropriations Act, IRS and Treasury have identified a dozen or so additional needed guidance projects. Add to that 38 other pieces of guidance published in the Internal Revenue Bulletin last year due to the coronavirus, including the extension of hundreds of filing and payment deadlines. While some of these policy changes are modest, some are fundamental, like TCJA's international tax provisions that change the entire architecture of how the U.S. taxes foreign earnings. Now, President Biden has put forward a number of tax proposals during his campaign, which he will try to move through Congress. More and more, the tax law has become a way of addressing economic and societal challenges, and I do not see that slowing down anytime soon. That brings me to a couple of tax administration items. First, FAQs. FAQs have been used increasingly since the coronavirus, mainly with respect to the Families First and CARES Acts. The Treasury and IRS wanted to quickly provide taxpayers and their advisors with insight into the government's thinking with respect to those laws. But FAQs are not binding on taxpayers, and they do not carry the weight of a regulation. Their increased use is a product of the times in which we're living, and I would expect to see them used less in the future. Second, OIRA's involvement in the tax regulatory process has been a topic of much speculation. OIRA serves as a clearinghouse for every administration to make sure that different agencies within the same administration are not implementing conflicting policies. For the tax regulatory process, OIRA has two functions. First, it distributes draft Treasury regulations to all federal agencies for review and comment. Second, it makes sure that Treasury regulations comply with the Administrative Procedures Act. OIRA focuses almost exclusively on the preamble, not the substantive regulation. OIRA does not have any technical tax expertise, so it can't second guess the interpretive and policy calls in Treasury regulations. It focuses on the economic analysis, the regulatory flexibility analysis, the Paperwork Reduction Act analysis in the preamble, and it makes sure the preamble responds to public comments. That may change in the new administration, but that is how it has worked since Treasury and OIRA entered into their Memorandum of Understanding in 2018. Third, the OECD and digital services taxes. Nobody knows how all this will turn out. As some members of Congress have said, the activity of some foreign countries in this area is nothing short of predatory. This topic will take up much time and attention this year. Ironically, the amount of money involved in Pillar 1 is exceedingly modest. Pillar 2 is different, but Pillar 1 gets all the attention. If something is agreed to, I have three predictions for you tonight. First, it will not be simple. Second, it will not have the support of the business community uniformly. And third, it will be difficult to get any OECD agreement through Congress. Not impossible, but difficult. Next, let me talk briefly about another tax administration item. All this change over the past 3 years, especially over the past year, has put enormous pressure on the entire tax system, but particularly on the IRS. The IRS deferred the start of the filing season this year because it had to make 2 rounds of economic impact payments, change its forms, instructions, and software to address the tax provisions in the 3 bills that I mentioned earlier, and deal with the coronavirus of all things. Using the IRS to administer social programs is not new. It started in earnest with the EITC. Now there are around a dozen of these types of provisions, and I do not expect this trend to stop. Using the IRS to distribute payments, like economic impact payments, makes sense in many ways, but it's not a traditional IRS function. So the IRS will need to reallocate some of its resources and recalibrate its thinking and focus somewhat. Again, this is a trend that's not likely to stop. Finally, let me say a few words about the recent IRS report on implementing the Taxpayer First Act. That will affect every one of us. The Taxpayer First Act's 45 provisions are designed to transform how the IRS interacts with taxpayers. The report has 3 aspects to it: the taxpayer experience, the IRS organization design, and training within the IRS. The report has some bold proposals, and if implemented, they will fundamentally change the way the IRS functions and interacts with both taxpayers and tax professionals. We all need to pay close attention to this issue in the coming months.